Okay, let's unpack this. Have you ever walked into a Costco, maybe for those legendary hot dogs, or bulk paper towels, and just stopped and wondered about the massive machine behind it all?
Yeah, it's pretty impressive when you think about it.
Well, today we're taking a deep dive into the business model of one of retail's true giants, Costco Wholesale Corporation. And our source material for this is a really comprehensive financial research report. It pulls back the curtain on, well, everything from their latest earnings to their long-term financial health. And crucially, how they measure up against some pretty rigorous investment criteria.
Right. And what's fascinating here, I think, is how Costco's unique approach creates this remarkably stable growth, strong returns year after year. But at the same time, it presents this valuation puzzle for a certain kind of investor. So our mission today is really to extract those core insights, understand its strengths, its risks, and then, evaluate it through the lens of value investing principles.
It's exactly. This isn't just about crunching numbers. It's about understanding the inner workings of a highly effective business, maybe one that's often misunderstood, but one that touches millions of lives every single day. So let's start by looking at their recent performance. Okay, so Costco's latest quarter, the one that wrapped up May 11th, 2025, it delivered a pretty clear message. Robust growth, excellent operations. Their total revenues surged to over $63 billion. That's an impressive, 8% increase from the year before?
Yeah, solid growth there.
And what really stands out, I think, beyond just the strong net sales, is the continued growth in their membership fee revenue. That climbed up to $1.24 billion. These figures aren't just big numbers, right? They signal a business that's really firing on all cylinders. It seems driven by increased customer traffic and just a steadfastly growing membership base.
And if we connect those numbers, those impressive numbers, to the bigger picture, it really all boils down to their core model, the membership warehouse club. It's actually elegantly simple. They move massive volumes of goods, everything from fresh produce to electronics, and incredibly low markups.
Right.
The key, of course, is you need that membership to get in the door and access those prices. Their revenue streams are almost entirely from merchandise sales, about 98%. And then the remaining 2% comes from those annual membership fees.
Okay, that 2% from membership fees really caught my eye. I mean, it seems like such a tiny piece of the overall pie.
Yeah.
Yet we always hear how crucial it is. How is it that vital to their success? What's the genius behind that small percentage?
That's a great question, and it really highlights the brilliance of their model, actually. Because despite being a small percentage of their total revenue, you said it, around $4.58 billion out of over $242 billion in fiscal 23, those fees are absolutely vital to their profitability.
Ah, okay, profitability.
Yeah, think of them as high-margin, predictable, recurring revenue. It just keeps coming in, and that allows Costco to maintain incredibly low markups on their merchandise. They can sell stuff at, or sometimes maybe even below cost in certain cases.
Wow.
And that perceived value, that drives membership retention, attracts new signups. It creates this really powerful self-reinforcing cycle.
So they pass the savings on, which makes people loyal, which lets them keep prices low.
Exactly. It fuels that loyalty directly.
And speaking of loyalty, I mean, their customer base is just huge, nearly 128 million cardholders back in 2023. But what's truly astonishing, I think, are those renewal rates, 92.7% in the US and Canada and 90.4% worldwide.
Yeah, staggering numbers.
When you see renewal rates consistently above 90%, what does that fundamentally tell you about Costco's, customer value proposition?
Well, it tells you they're not just providing a service. They're delivering immense, sort of undeniable value that really resonates deeply with their members. You don't buy that kind of loyalty with advertising. You earn it by consistently exceeding expectations, price, quality, the whole shopping experience.
Right.
It's proof, really, that their members genuinely believe they're getting a fantastic deal year after year. And operationally, by the end of fiscal 23, they were running 861 warehouses worldwide, most in the U.S., obviously, employing around 316,000 people, and about 95% of those folks work right in the warehouses and distribution centers.
And they have that reputation for paying well.
Yeah.
Right, above average for retail.
They do, yeah. Which helps keep turnover low, definitely supports the model, but it certainly adds to their overall costs, particularly compensation and benefits. That's a big chunk after the merchandise itself.
Okay, so even a company as strong, as seemingly invincible as Costco, isn't immune to external pressures, right? What are some of the challenges they face, maybe short-term and long-term, that could impact their operations or, the bottom line?
That's right. No business operates in a vacuum. Short-term, Well, you've got the usual suspects: inflation, the specter of recession, rising commodity costs, wage costs. Those can squeeze their already thin merchandise margins.
Uh-huh.
And an economic slowdown, well, that could dampen spending on non-essential items. Supply chain disruptions are always a risk, as we've all seen. That impacts inventory, costs. And foreign exchange, a strong dollar can hurt their international revenue when translated back.
And competition, always a factor, I assume.
Oh, absolutely. It's relentless, not just from the discounters like Walmart and Sam's Club, but increasingly from e-commerce giants like Amazon.
Yeah.
That could challenge their pricing, maybe even membership retention over time.
Looking further out, long-term risks.
Well, some analysts point to their maybe slower digital transformation compared to some rivals. E-commerce, delivery,
Right.
that could erode market share if they don't keep pace effectively. Labor and regulatory pressures are ongoing concerns. Rising minimum wages, unionization efforts, those could increase operating costs.
Yeah.
Changes in trade policies, tariffs, that could impact their cost of goods. And increasingly, ESG, environmental, social governance expectations from consumers, regulators, that might require significant investments down the line. Sustainability, packaging, supply chain changes.
Okay, so given those pressures and their commitment to paying employees well, how do they manage to keep prices so incredibly low? How do they maintain that competitive edge? What's the secret in their cost structure?
Yeah, their lean cost structure is really the backbone of that value proposition. Their single biggest expense by far is just the cost of the merchandise itself. That was a staggering, $212.586 billion of their total revenue in fiscal 23.
Wow. So,
Beyond that, you have SG&A selling, general administrative expenses. That was about $21.6 billion in FY23, mostly payroll and benefits. But get this, that's only roughly 9% of their total sales, which is remarkably low for a retail operation of this massive scale.
9%, okay. And it's fascinating how little they spend on traditional advertising compared to other big retailers. So how do they keep growing that membership base, attracting new customers without these huge marketing campaigns? What's their secret sauce there?
It is quite remarkable, isn't it? Their mentorship growth is overwhelmingly driven by just powerful word of mouth and the sheer perceived value they offer.
So people just tell their friends.
Pretty much. Customers are so satisfied they become organic marketers for the brand, sharing positive experiences. It's a highly effective, super low-cost marketing strategy. Very few companies can really replicate that.
That makes sense.
And beyond those core operating costs, Costco is definitely investing in the future. They spent about $4.3 billion on capital expenditures in FY23. And they're planning even more, like $4.4 to $4.6 billion in FY24 for new warehouses, expanding logistics.
Right.
They're not standing still.
Right. And who's steering this enormous ship through all these market dynamics, all the operational complexities? What does the leadership look like?
Well, Costco's management team is really characterized by incredible longevity and deep operational experience. W. Craig Jelinek's been CEO since 2012. Many executives like Ron Vacris, the president and COO, and Richard Galanti, the longtime CFO, they've worked their way up through the ranks, often started right in warehouse operations.
Ah, so they know the business from the ground up.
Exactly. It fosters this strong culture of operational discipline, that unwavering commitment to low prices. They understand the nuts and bolts. Plus, management owns shares, which naturally aligns their interest with the broader shareholder base.
And the major owners.
Looking at the top shareholders, it's mostly the big institutional investors. Vanguard, BlackRock, State Street, Geode Capital, FMR, Fidelity. The usual suspects for a company this size.
Okay. And beyond just running the business day-to-day, their financial discipline seems to extend to how they treat shareholders, too. We've seen things like that big $4 billion share repurchase program, authorized through January 2027. That shows confidence in their own stock, right?
Definitely. And they've been actively buying back shares. For example, they bought back about 1.3 million shares for $677 million just in FY 2023.
And then there are the dividends. Consistent quarterly ones, plus those famous special dividends like, wasn't there a $15 per share one back in December 2020?
That's right. Those special payouts really speak volumes about their cash-generating power.
Yeah. It's interesting, too. I remember Berkshire Hathaway was a longtime holder, but they sold their Costco stake a few years back. Maybe that hints at the valuation discussion we're about to get into.
It certainly adds another layer to the puzzle, yeah. Valuation is key here.
Okay, perfect segue. Now we get to the core numbers for those of you who really love to dig in. Let's look at their 10-year financial performance. How have they actually grown and managed their finances over the past decade?
Absolutely. So looking from fiscal year 2014 through 2024, Costco has shown just remarkable consistency and growth. Revenue more than doubled, grew at a solid 8% compound annual rate, hitting $254.5 billion in 2024.
8% CAGR, okay.
Net income nearly quadrupled, climbing up to $7.37 billion. And what's striking is how stable their net margin has been, consistently hovering right around 2.9%.
Consistent, but maybe not super high.
Right, that's part of the model. Operating income also grew steadily to $9.29 billion, keeping that operating margin around 3.6%. Now, free cash flow, or FCF, that's the cash left, after paying for operations and investments, it's been positive every single year, which is great, though its margin is relatively modest, around 3%.
Okay, 3% FCF margin. And returns.
Returns look outstanding. Return on equity, ROE, averaged about 24%. Return on invested capital, ROIC, around 18%. Both indicate really efficient use of capital, strong returns for shareholders over time.
And the balance sheets. Debt.
Rock solid. Their balance sheet is incredibly strong. Long-term debt was a manageable $5.79 billion at the end of fiscal 24. And that's comfortably offset by cash on hand, which was over $11 billion.
Wow, more cash than long-term debt.
Exactly. So that gives them a very low debt-to-equity ratio, about 0.14, current ratio over 1.5, interest coverage over 30 times. So by all those traditional measures of financial health, operational efficiency, Costco looks like an absolute powerhouse.
Okay, this all sounds incredibly strong, right? Every number seems to point to a powerhouse. But here's where that puzzle really emerges. How does Costco, with all these impressive underlying numbers, fare when you put it to the test against those strict value-oriented criteria, the kind championed by investors like Warren Buffett? Does a great business always make a great stock buy at any given time?
And that is indeed the crux of the puzzle, because despite its operational excellence, Costco's stock often trades at a significant premium. And that premium causes it to fall short on several of those traditional valuation discipline criteria that strict value investors prioritize.
Like what, for example?
Okay, well, take the PE ratio, price to earnings. In 2024, it was around 55. The typical value investing standard is often, less than or equal to 15, so way above.
Yeah, big difference.
Same with price to book ratio. Around 12 for Costco versus a standard of maybe 1.5 or less. And the concept of a margin of safety, buying significantly below what you think the intrinsic value is, say 25% below, that's challenged here. The current price, around $916, often exceeds the more conservative discounted cash flow valuations.
Okay. Any other metrics where it falls short for value investors?
Well, yes. While the free cash flow is consistently positive, that margin we mentioned, around 3%, it's below the desired 5% or higher that many value investors look for in highly cash-generative businesses. Their estimated return on retained earnings, maybe 3–5%, also falls short of the typical 12% benchmark some use. And critically, those margins we talked about, gross margin around 13%, net margin around 2.9%, those are significantly lower than the 40% gross or 20% net margin standards often sought by value investors looking for businesses with really wide moats and high pricing power.
Right, those high margins often signal a stronger competitive advantage, theoretically.
Exactly. Now, where Costco does truly shine, even by Buffett criteria, are in areas reflecting its underlying quality and financial health. Its EPS record, consistently rising for 10 straight years. Strong track record.
Okay, that's a pass.
Book value per share grew around 9% CAGR, which marginally passes the 10% standard some look for. Debt to equity at 0.14. Excellent, way below the 0.5 standard. Interest coverage over 30x, interest expense only about 2% of operating income, both exceptionally strong. Shows real financial discipline. Current ratio over 1.5, good liquidity. And those profitability metrics we liked earlier, ROE around 24%, ROIC 18%, ROA 11%, they all comfortably exceed their respective standards. Even things like depreciation as a percentage of gross profit, around 10%, that passes the test too.
So it's this weird mix then. It
Yeah.
excels in profitability, balance sheet strength, consistency, yet it kind of fails on many of the valuation discipline metrics.
Right.
What's the fundamental reason for that split? Why the dichotomy?
It's simply because the stock consistently trades at premium multiples. The market seems really optimistic about its future growth, its stability, the durability of its business model. Investors are clearly willing to pay a high price for that quality and consistency. It's a quality premium, essentially.
Okay, so Given all these factors, the strong business, the premium valuation, what does this all mean for its actual value per share? Especially when we use something like a discounted cash flow or DCF analysis. What does that tell us about the current price?
Right. The DCF analysis tries to put a number on that intrinsic value based on different assumptions about future free cash flow growth. So, using their fiscal year 2024 free cash flow, about $7.88 billion as the base, and standard assumptions like a 9% discount rate, 2% terminal growth. We modeled 3 scenarios based on the recent price around $916. This is as of August 2025.
Okay, what do they show?
Well, in a conservative scenario, assuming basically 0% FCF growth going forward, the intrinsic value comes out to about $222.71 per share. A 25% margin of safety buy price would be way down at $167.03.
Okay, very far from the current price.
Very far. Now, under a nominal scenario, using their actual 13.8% average FCF growth rate, the intrinsic value rises to $623.58. The margin of safety buy price there is $467.69. Still well below $916.
Getting closer, but still a big gap.
Right. And finally, in a really optimistic scenario, assuming a very high FCF growth rate of 25.1% continues for years, then the intrinsic value jumps to $1,433.06, and the margin of safety buy price would be $1,074.80.
So only in the really optimistic case does the current price look potentially reasonable or even cheap with margin of safety.
Exactly. What's fascinating here is that the current market price, around $916, is well above both the conservative and the nominal intrinsic values. It only falls below that highly optimistic valuation scenario. So this means investors who are really seeking a large margin of safety, which is typical of a strict value investing approach, might find the shares quite expensive at their current trading levels.
So we've taken this deep dive into Costco. And what a fascinating journey, really. On one hand, you have this incredibly robust, membership-driven model. Stable growth, consistent returns, fiercely loyal customers. It's a business known not just for value, but also, for treating its employees well, which is great.
Right. But on the other hand, the stock trades at these premium valuation multiples that, as we just saw, cause it to fail many of those strict value-oriented criteria, particularly around margin of safety. The business is phenomenal, no doubt. But those free cash flow margins are modest compared to some benchmarks, and the stock's implied margin of safety looks narrow unless you assume pretty aggressive future growth.
So what's the takeaway for an investor looking at this?
Well, ultimately, it seems like long-term, maybe growth-oriented investors who really believe Costco can sustain that double-digit free cash flow growth for a long time. They might justify paying the current price. They're paying for quality and expected future growth. However, more conservative investors, the ones who really prioritize a significant margin of safety and strict adherence to valuation discipline, they might prefer to wait for a substantial pullback in the price before considering an investment. It depends on your philosophy.
Yeah. And what does this all tell you, the listener, about that fundamental tension in investing, the tension between a fantastic business and a potentially challenging stock valuation? Do you prioritize owning a great company, maybe at almost any price? Or do you wait for a great price, even if it means missing out on some great companies sometimes? It's a core question every investor has to grapple with, right?
Yeah, it absolutely is. And just a reminder for everyone listening, as always, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. This content is for educational purposes only and does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.
Great points. Thank you for joining us on this deep dive into Costco. Until next time, keep learning and exploring.